Good morning, everybody. Welcome to Wise Tech for Wise Money. This is the podcast where we speak with founders, advisors, and leadership teams who are actively building businesses and shaping how capital is managed in practice. I'm Gary Wayne, founder of A1 Solutions International. We work with RIAs, family offices, financial services firms to improve efficiency and grow intelligently through smarter strategy and better use of technology. Today's episode is titled Beyond the Model Portfolio, Building High Net Worth Client Portfolios Through Direct Ownership. It focuses on portfolio construction, client engagement and the practical realities of acting as a fiduciary in an increasingly product-driven advisory landscape. I'm joined today by Nicholas Filippo, Principal and Chief Marketing Officer at Tower Bridge Advisors, a Philadelphia-based registered investment advisor focused on managing high net worth client portfolios through direct ownership of individual securities. Good morning, Nick. It's really good to have you here. How
Morning,
are you?
Greg. I'm doing well. Great to be here. Thanks for having me.
And you're bearing up okay in the weather?
We're doing just fine. You kind of dig out and move on with life.
Fantastic. So, talking about life, maybe you could give us a little bit of background about your career, your journey, how you came to be one of the main players at Tower Bridge Advisors, and the clients you typically serve.
Sure. Just my quick background. I started out after college in the technology business. So I worked for IBM for about 10 years and then moved into the investment management business in various different roles. I was a broker at Paine Webber for a while. I got into a reverse mortgage business in the early days of that. And then I worked for a financial services and technology firm called SEI Investments. And I've been with Tower Bridge for 13 years now. And so our firm manages about $1.5 billion. Our clientele is mostly high net worth individuals. We have $1 million minimum. And when I say mostly high net worth, we do some institutional work, but it's typically a family foundation. It's a not-for-profit that's fairly small in size. We don't do the large pension funds. So our strategy is, as you mentioned, individual securities. We manage individual stocks and bonds for clients, a little different than a lot of advisory firms these days. The business has changed quite a bit in the last 10 years, I think, where most advisors or a lot of advisors in the business are asset gatherers. And so the goal is to gather assets, move into model portfolios, exchange-traded funds, mutual funds, that sort of thing, and then move on and try to find the next client and gather additional assets. Our strategy around individual securities stems from the background that our advisors have as analysts. We have a team of 8 portfolio managers and analysts who all have backgrounds in analyzing companies, analyzing stocks, understanding valuation, understanding company fundamentals. And so the portfolios that we build are typically large cap portfolios, individual stocks, again, companies that we know well, companies that are covered well. And on the fixed income side, we buy individual bonds, typically government corporate bonds, and depending on the client's tax status, we'll buy municipal bonds as well. We think there's some distinct advantages to this style of management. Number one is transparency. I see clients all the time come to us with portfolios of mutual funds, and this isn't a criticism of that style of management, it's just sort of point counterpoint. But when I look at a portfolio of mutual funds, I had a client recently brought us 18 mutual funds that they had in a portfolio of theirs. And when you look at it, you have no idea what you own. Not sure how that portfolio was constructed. Why do I have 2 large cap growth funds? Why do I have 3 international funds? So the client, number one, I think doesn't really know what they own. There's a lack of transparency as to the underlying holdings, so you don't know if you hold Apple and Microsoft in every portfolio. Do you have no Apple and no Microsoft? These days, as you know, the Magnificent Seven, as they're called, have driven a lot of the growth in the markets in recent years, so clients don't really know if they're over or underexposed to a stock. We also pay close attention to industry sector allocation. These days, again, I think back to the tech bubble, when I knew people who had 50-60% of their portfolio in tech, and then when the bubble burst, it really just completely decimated those portfolios. We like to pay attention to sectors, so you don't get out over your skis too far in any one sector. We tend to try and stay fairly within range of the S&P allocation, but that allows us to make a decision as to whether we want to over or underweight a specific sector, which we will do, but typically we'll stay within 50% one way or the other, either plus or minus. But we don't typically want to be out of a sector because, again, now you're trying to time the market, and we just don't think that makes sense. So we think the transparency of the portfolio is a big differentiator. Number two, having access to your portfolio manager, I think, is a big deal. I always tell people, when you look at a large mutual fund in your portfolio, if you try to talk to the portfolio manager, you will have zero chance to do that. You're going to get a 1-800 line, you'll get a nice 28-year-old on the phone who's going to read from a script and tell you what's in the portfolio, but you'll have no transparency into how that manager actually manages the portfolio, how they make decisions. So we think access to the portfolio manager is another big benefit. And another one is tax management. We typically will help clients manage capital gains taxes in their portfolio. We have some clients who are fine paying the taxes, and if we want to move out of a stock that has a gain, they say, fine, I'll pay the taxes. Other clients are very sensitive to the tax impact. So in many cases, we'll hold off on making a sale. We'll kind of bleed it out over time. When you're in a portfolio of mutual funds, you have no control over taxes. You get your tax bill at the end of the year, whether you made money or not. If the mutual fund manager did trades in the portfolio that resulted in capital gains, you just get the gains. So we think that's another benefit. And then finally, when you look at our fees, the fees that we charge to our clients are 100% of the fees that the client pays. So there is no underlying fee because there are no fees in the funds. When you deal with an advisor who charges a fee for their services and then puts you into mutual funds, those funds have underlying expenses as well. Many clients don't realize this. Everybody knows that sort of the vanguards of the world have low fees, but when you look at a lot of other fund families, the fees can run 50, 70, 100 basis points or more. And when you tack that onto the fee that the advisor charges, now you've got potentially 150 to 200 basis points that you're paying in fees, we believe, unnecessarily. So we think those are the benefits of why we manage the portfolios the way we do, and I think our clients appreciate the benefits of that.
Well, what fees do you actually charge, Miles?
We charge 0.85%, so 85 basis points on the first 5 million of assets, and then we have break points above that. So we think that that's a reasonable fee. We're happy with the money that we make doing that, and we think that it's a good value for the client. A lot of advisory firms these days, 1% is sort of the standard out there. And like I say, if a client's paying 1% to the advisor and then their underlying fees as well, now you're well north of 1%.
What actually made you in the beginning focus just on individual securities?
It's the fact that the founders of the firm had backgrounds as analysts. And so what they knew was looking at stocks, understanding companies, doing deep analysis. And so that's the legacy. The people that the founders hired over time were people who likewise had backgrounds in security analysis. And like I say, when you look at the couple different ways you can manage portfolios, whether it's funds and ETFs versus individual securities, we thought that the benefits of the individual securities were really a big benefit for our clients.
Clients better understand the stocks they own nowadays as opposed to looking at pooled funds?
Yeah, it's interesting. When we do reviews, we typically do quarterly reviews with clients, and we'll show them their portfolios. And some clients have deep interest in the stocks. Some have little interest. Some have knowledge because now you've got all the cable networks and you've got all the cheddar all day about the stock market. Everybody knows the name NVIDIA now, and certainly everybody for years has known Microsoft and Apple and Amazon. So even just the average client who doesn't have much of a background knows what these stocks are. When I meet with prospects, I show them what a sample portfolio looks like, and I tell them all the time, and this is true, that you could point to any one of those stocks in the portfolio, and your portfolio manager can tell you why we own it, what the thesis was behind owning it, what we think the value is of it, where we think the stock can go over time, what our sell discipline would be if it hits certain triggers. And so when we do meet with clients, we'll go through the portfolio and talk about some of the holdings, purchases we made since the last time we met, sales that we made since the last time we met, and then if clients have any questions, they can go through the portfolio. And I'm telling you, every one of our portfolio managers can do 20 minutes off the top of their head. Why do you own this? What's the thesis? When did you buy it? What was the trigger for buying it? And what's going to be your trigger for selling it? So I think clients do appreciate that. And it's a bit of an interesting dynamic when you have a client who comes from a portfolio of mutual funds. Sometimes they're a little hesitant on the individual security side. They say, well, don't I have great diversification with the mutual fund? But the reality is, by the time you hit about 40 stocks, you've done about as much diversification as you can do. There's a study that shows that once you get beyond 40 to 45 stocks in a portfolio, adding additional stocks does very little to move the needle on volatility. And that's really what you're trying to manage when you talk about diversification. So when clients look at this portfolio of 40 stocks, initially they might think that's not enough to be diversified. But once you have a couple of meetings and they see that you really know the names, you know why you own them, they get a lot more comfortable, and then they start to really appreciate the benefits of that, especially, like I say, when it comes to tax time, that we can manage taxes.
Just a question for me, because I come from the market. How do people like RIAs and traders in your area manage downside volatility? I mean, we know everybody can be long, but what when the market tanks? How do you manage that, and what can you do about it? And can you maximize it coming off?
Yeah, it's a tough thing, and it's one of those things we try hard to explain to clients, especially with a new relationship, that there's no place to hide, other than going to cash. There's no place to hide in the market. So when the market tanks, everything's going to get hit. We saw this interesting dynamic in recent years where they talk about having portfolios that are non-correlated. Well, there have been some hits that the market's taken where everything was correlated and everything went down. So in some regards, there's no place to hide. What we try to do to manage downside risk is two things. One is asset allocation. So by having an allocation of fixed income, we feel like we can manage some of that downside risk just by the nature of the fact that the bonds typically won't take a hit. And we tend to be shorter term with our bonds. Again, we don't like taking duration risk with the bonds. And since we buy governments and corporates, we tend not to have risky bonds. So having fixed income in the portfolio protects some of that downside. The other thing we think protects the downside is having large cap names in the portfolio that we believe are companies that have a strong business model, they've got a strong moat around them, and while they will take a hit, typically you're going to see the stronger companies come back stronger when they come out of that downturn. So like I say, there's no way to hide. There's as you've seen recently, there's a lot of volatility in the market, and some good stocks get hit when the market goes down. But we believe in having high quality companies because eventually, as you know, the market does come back eventually. And rather than having speculative companies in your portfolio that may never come back, having high quality, good names in the portfolio, they will come back over time. And so that does help you manage some of that downside risk. It doesn't protect you from the initial hit, but it helps you when things come back. You know that the portfolio will return to hopefully where it was previously.
If I gave you $2 million to, just for example, to invest for me, would you invest the whole 2 million, or would you hold some in cash so that if there was a downside movement, you could buy it cheaper?
Yeah, it's different for each client. So I'll give you an example. We have a client come on board who has their money in the market today. Suppose they've got $2 million and it's all in, equity funds today. And I would say let's assume that's a client who's in a tax-deferred account. It's in an IRA. If they've got $2 million in the market today and they come to us and we want to move out of those holdings and put them into our portfolio, we'll move them in right away because the idea being they're in the market already. We don't want to take them out and now make a timing decision. If a client comes to us with $2 million in cash, that's a different situation. So depending on what we feel about the valuation of the companies, we may move some of the money in and then leave some on the sidelines, especially the last couple of years, money markets yields had improved to where you could get, 4.5%. Now yields are down somewhat, but at least in a money market, you could get these days, 3 to 3.5% and be making something on your money. Since we do manage balanced portfolios, if that $2 million comes in and we want to balance that, we can obviously buy some bonds right out of the box. So now you've at least putting some of that cash to work. You can put some in cash, some in bonds, and then on the equity side, we're big believers in looking at valuation of companies. So the way we manage portfolios is a combination of growth and value. So we believe in buying growth companies. Again, firms that we think have the ability to grow their business, continue to reinvest in their business. But we also want to look at valuation. And as you know, these days valuations have gotten pretty high. The S&P typically is at 16 to 18 times earnings. The number keeps moving north of that. And, some people will say it's overvalued. Other people will say it's different this time. This is a new normal. So we look at valuation of individual companies. We set what we think is fair value for a company and then make our buy and sell decisions based on that. So let's say we have 40 stocks in the portfolio. You've got $1 million to invest in stocks. We might move some of it in initially with those companies that we feel the valuation is fair. We might leave some on the sidelines and wait until we think valuations for the other companies come back, or when there's a new opportunity, a company that we find that we're adding to the portfolio, then we'll move it in then. But yeah, we'll typically move it in over time if it's coming in all in cash. if it's coming in already in equities, we want to put it in because we don't want to make a timing decision.
Sure. You said, I think your minimum investable amount is $1 million.
Correct.
Well, who is your ideal client?
Yes, I will tell you, our typical client has $3 million with us. So our minimum is a million, our typical client has 3 million. And I will tell you, our client base is what I call, this was a term coined years ago, but the millionaire next door. You know, it's the couple who's 70 years old, who earn a decent living, didn't buy an extravagant house, didn't have a boat, didn't have a second house, paid their kids tuition through college, were fairly frugal throughout the years, and now they got $3 million. And they're 70 years old, and they're saying, we want to spend some of this money on ourselves, we want to grow in a reasonable pace, and then we want to leave some to our kids when we pass. So that client has a mindset of having a balanced portfolio, some stocks, some bonds. It totally makes sense to them. They understand individual securities. So that's a very good client, and that's what a lot of our clients look like. On the other end, we've got clients who have either inherited money or who have significantly more assets because they sold a business. And so those clients have sort of a different viewpoint. Some of them are doing philanthropic giving with a significant portion of portfolio, or they have plans for how much they're going to leave to legacy in the family. And then we have other clients who are perhaps at that $1 million minimum level or slightly below, but they're growing their portfolio. It's the 40-year-old who earns a really good living, a couple who both work, earn a good living, are putting a bunch of money aside, and will continue to grow their portfolio over time. But I'd say the thing that kind of runs through with all of our clients is they understand the strategy of individual securities. They understand what we do. They want to get growth, but they're not interested in the go-go growth. So the one thing we tell people right out of the box that we don't do is we don't speculate. We don't buy small cap stocks that we speculate on. We're not into speculative investing. We think that that's not really investing, that's speculating. If you want to do that, that's fine, but that's not what we do. And so our typical client is somebody who wants to grow their portfolio at a reasonable pace over time, have reasonable objectives, and we can typically meet those. The other thing that's important these days is client service. And I think our clients typically will come to us for help across a number of issues that they may have. And it might not be related to their finances. It might be sort of personal issues, or it might be, we're thinking about buying a second home, should we do it? We've got a client who came to us because they had come across an opportunity to invest in a franchise, and they really didn't know how to assess it. And so even though they had no background in it, they knew they ought to come to somebody who could help them. So we took a look at the franchise agreement, we took a look at what they'd have to put in, look at what the competition looks like, and gave them some advice on that. Again, we don't get paid to do that. It's not like we charge an extra fee for some consulting, but it's part of what we do along with just meeting with our clients on a regular basis. So I think our typical client appreciates the fact that they can come to us for that sort of advice beyond just the portfolio.
How much of prospective client wealth is still tied up in retirement plans like 401ks?
Yeah, that's a real issue. When we talk about $1 million minimum, I'll talk to a prospect who says, well, I've got about $1.5 million, and then when we start to talk to them, $1.2 million of that's in their 401k plan at work. So we can't manage that because it's still in the plan. Now, when somebody hits 59 and a half, typically they can roll money out of the plan even if they still work there. But what we will do is, and that, like I said, it tends to be a younger client, somebody who's still working. I'm talking to somebody just the other day who has been retired for a couple of years but still has money in the 401k plan. Well, we can roll that money out of the 401k plan into an IRA, and then we can manage it. But if they're still working and under the age of 59 and a half, typically that money, we can't really touch in the plan. But what we will do is, I will tell people, at some point, you're going to roll that out of the plan, or you're going to leave that company and go elsewhere, and you may want to roll that money out into an IRA. We'd love to keep in touch with you. So we do what is referred to in the business as drip marketing. So we have a piece that we write once a week. It's sort of a 50,000-foot view of the markets and what's going on in the investment space. And we send that out to clients, to prospects, to centers of influence, attorneys and accountants, people like that. And so it's a way for us to sort of stay in front of people who may not be clients today, but it gives them an opportunity to see what our thinking is about the markets, see how we think about investing, and just stay in touch with us over time. And then when that person who's 50 years old and changes jobs and they got $1 million in their 401k, they can roll it over at that point. We would hope that they would come to us, given the fact that we gave them some advice along the way and given them.
Are younger entrepreneurs harder to reach due to illiquidity?
Yeah, It's an interesting world with the younger generation. Couple things. Number one, there's so much do-it-yourself out there these days. There's all these tools that have been created to help individuals manage their money themselves, and so I think you have a lot of people who think they can do that, and some of them, are quite successful doing it, and some people actually enjoy doing it. I've had clients who've come to us and said, I've had fun doing this. Now I'm going to give it up to you guys. I'm struggling with that. And just as a side note, with some of those people, we'll actually tell them, well, why don't you keep some money to the side? Keep your E-Trade account, keep your Schwab account on the side, and go ahead and manage some stuff yourself and enjoy doing that, and then let us do what we do on the other side. But back to your question about the younger entrepreneurs, yeah, it's tough because in a lot of cases, those people are very busy with their business. They don't really want to engage. And when they're getting close to having a liquidity event, they got bankers, they've got people coming to them to help with the transaction. And obviously those people not only want to help with the transaction, but they want to help manage the portfolio once there's a liquidity event. So now you're sort of competing with that. And now I'm the outsider versus the investment banker with whom they have a relationship already. So it can be difficult to find those people. We find the best opportunity for us is through, as I call, the centers of influence. So attorneys and accountants and people who are out there dealing with those people. The accountant who knows the client of his who's selling a business and comes to us and says, hey, I've got this client, he could really use some help. I'll introduce you guys. That's a great introduction because now it's not a cold call from me, but rather it's somebody that they trust recommending somebody. So that's typically how that will happen these days. But yeah, that's kind of the goal. Everybody in our business would love to have the 40-year-old client who has a liquidity event and now is going to be a good client for the next 40 years. Because we're all challenged with the challenge of having an 80-year-old client who may not be around another 10 years. And so that money, while you can build a relationship with next generation to some extent, a lot of times that money leaves when that client passes. So like I say, that 40-year-old client is a hot commodity in our business.
Do you, so in marketing or trying to get hold of the younger generation, you rely on centres of influence for them to put them forward?
Yeah, like I say, that's typically the best way. And so what we try to do is try to build those relationships with the centers of influence. And it goes back and forth. We have clients who come to us, and I just had a client the other day who said, my accountant is retiring. Do you know anybody? And so we'll pass along the name of an accountant that we know who does good work. And we don't do referral fees. I don't ask that accountant to pay me something for that referral. But what I do is I pass along a name of an accountant who does work for our existing clients, who I know has done good work, is thoughtful, is helpful, is smart at what they do. We'll pass along that name. And so if I can help that accountant with their business, hopefully they remember us when the time comes. Same thing with the attorneys. We've built some relationships with attorneys who've done work with our clients and been introduced to a number of really sharp people in the area who do great work. And so I will always tell a client, I'll give you a couple names. I can give you a boutique who's got probably a lower price point and maybe is more accessible. I'll give you a mid-tier person who's a different kind of firm, a little bigger, more resources perhaps. Probably the fee is going to be a little higher. And then I can introduce you to the big city law firm who's going to charge top dollar, and you might get a paralegal that you deal with most of the time and get the partner's time part-time. But if that's what resonates with you, then you should do that. So typically the client will go and sort of interview those three people and see how comfortable they are. But that really works well when we can build that relationship and that attorney or accountant knows us and we know them, and then you can have referrals that go back and forth. Because again, I can't be in front of these people, 5 days a week. Even if you have an email address, the last thing you want to do is bombard them with information. That just turns them off. So like I say, we do our drip marketing kind of one piece. And the other thing that works well is if you know somebody who is in a situation where, like you say, they might have a liquidity event at some point. If you know enough about their business or their situation and you can send something to them that's timely or helpful. I read an article, don't know if you saw this, send that to them. Somebody you know who's in an adjacent business who might be a business partner for them, introduce them, that kind of thing. I think by being helpful to those people, that's where you build trust, and people view you differently than just an advisor who's out to manage their portfolio.
What typically prompts a client to reconsider their existing advisory relationship and take on a new RIA?
Yeah, that's classic. There's so many things that can cause that to happen. Trigger events are things like, an inheritance. Somebody might be dealing with an advisor that they feel like is okay for a smaller portfolio, but now they've inherited $5 million and they think they need a higher level of expertise. So they may start to look around. We've had a number of people, this business is full of advisors who are of a certain age where a lot of them are retiring right now. So you've got advisors retiring. I literally got a call yesterday from a guy who said, hey, my advisor just retired. I've been talking to you guys for years. We should talk a little further. So there's a lot of that going on these days because, like I say, there are a lot of advisors of that age who are retiring, and some of them, if they don't have a succession plan, the client's left to figure out what to do for themselves. Sometimes there's dissatisfaction on the part of the client with the advisor. They had a couple of bad interactions. They got poor client service. They haven't heard from the person. We do some work with 401k plans, and I was talking to somebody the other day with a 401k plan, and they said, we have an advisor on the plan, but I haven't heard from him in 2 years. And we'd like to know if our portfolio is in the right place. Should we change our options for our clients? So, and I'm always surprised when that person didn't reach out and call the advisor if I haven't heard from him in a year. Yeah. Sometimes the time will go by and they'll say, you know what, I haven't heard from this person. I need to make a change. So there are a lot of things that can cause that to happen. And unfortunately, from a marketing standpoint, there's not a lot we can do about that. I can't be in front of everybody all the time selling. So what you have to do is try to be in front of them when you can so they're aware of you, that when that event occurs, when they have a liquidity event, when there's a retirement, when there's dissatisfaction, they think of you. And that's why people in our business do a lot of branding, advertising, that kind of thing, just to keep your name out there.
You mentioned, there's a lot of people retiring, obviously in the baby boomer, age group. I've heard I've been told there's a lot of RIA firms looking to be sold. Is that correct? Because of retirements?
Yeah, there's a couple dynamics going on in the business. So number one is you have these aging advisors who founded a firm, 40, 50 years ago even, and now are looking to move out, and rather than just pass it along to somebody else, one way to create some liquidity is to sell the firm. So there's a lot of that that's gone on, and that's always happened over the years. And typically what happened was another advisory firm would buy them, or they would merge with somebody that they knew, or they'd build a relationship, or they'd have a succession plan where they bring on next generation, and that next generation would have to buy in and basically buy that person out over time. That was kind of how things worked for years, but in recent years the private equity business has gotten into buying RIA firms. And I think that there's a lot of private equity money out there looking to buy companies, and they look at the investment management business as being one that is very sticky. The clients are very sticky typically. It's not often that clients just leave en masse. You can have a dissatisfied client here and there, or there's a death, but typically the assets are pretty sticky. The margins are very good in this business also. So I think the private equity people looked at that and said, wow, these are great businesses to own. So private equity has come in and started to buy firms, and now there's any number of firms. Firms like ours get calls all the time from people seeing if we want to be acquired, or if we want to sell. I got a guy that hits me up endlessly saying, I can show you the best numbers that you're going to see out there, and we do great work for our clients, and we can get you the highest number. It's turned into this kind of feeding frenzy where the private equity money is so interested in buying these businesses that now it's not just sort of the typical buyers that were out there years ago. Now there's tons of players in the business doing that. So you'll find any number of models out there where there are large firms that are rolling up these RIAs. And, there can be some benefits in doing that. If you're this advisor who's looking to get liquidity for your business, that's one strategy, because now you're sort of walking away. But a lot of those advisors still really care about their clients, so they want to make sure the client's taken care of. So you want to make sure that firm that buys you has a great business model, that somebody's going to take care of your clients ongoing. There's some other people who are merging with other firms, and they're taking sort of private equity money on the side in order to do that transaction, because now you've got to pay some elevated number in order to buy that company, and sort of put two companies together or buy them out over time. So there's any number of models that are out there these days where not just retiring advisors, but existing advisors can get some liquidity, in some cases still manage their business, and perhaps increase the level of service that they get, or the level of services. A lot of these roll-ups are offering things that some of the smaller firms can't offer themselves, like if you don't do estate planning, or you don't have in-house tax people, If you don't have in-house financial planning, when you're part of a roll-up, those firms might provide those services to you that you can now provide to your clients. So yeah, I kind of went a little off track with the retiring advisors, but it's an interesting dynamic. Not only the retiring advisors selling, but there's plenty of existing advisors who have plenty of runway left who are selling their businesses to these PE firms or merging with other firms.
Lots of opportunity. Talking about financial planning, you mentioned using cash flow and modelling technology internally at some point. How has that improved client engagement?
Yeah, I'll tell you, it's been great. We use a tool that enables us to plug in a client's portfolio. It then makes some assumptions about what the growth rate will be. So we typically look at what the market's done over the last 75 years. Equities have returned on average about 8%, fixed income's returned about 4%, cash about 2%. So you can plug in the portfolio and assume those growth patterns. Then you can also plug in, though, their income and their expenses, both current, if it's a client who's still working, and then you can plug in at retirement, what do we think that will look like. Then you plug in Social Security is going to come in, or you have a pension. Plug all that in and give you a cash flow analysis. So now that gives you a baseline to say if things just stay as they are and if the markets were consistent 8%, 4% per year, you can see what your cash flow looks like. And now you can say, well, what if I want to give some money to the kids? What does that do? So now you take X amount of dollars in X year and move that to the kids. Or you say, what if the market tanks and we have a 20% hit to the market next year? What does that do? We can put that in and model that. We can go then back and say, okay, what if we don't have a big hit downside to the market, but what if the markets, instead of giving us 8%, only give us 5% on average over the years? Run that out. So it enables you to run different scenarios that gives a client a true sense for risk, reward, and gives them a sense for how we want to manage the portfolio over time to get to their goal. So typically a client who's 65 years old will run it out to age 95. That's a 30-year time frame. A lot can happen in 30 years. So you can have a lot of dislocations in the market. You can have years like we had recently where the market's up 3 years in a row, almost 20% plus each year. But people forget about the years. It was only 2022. The market was down almost 20%. People forget about that. Modeling that helps. The other thing that I think is beneficial is when we do this analysis, we can uncover assets that we perhaps didn't know about or that the client didn't think were something we could manage. So you'll say to the client, we managed X amount, we plugged in that portfolio. What else do you have? Well, I got this annuity. Okay, well, where's the annuity? How much is in it? Let's plug that in. Well, I got this $200,000 account at E-Trade that I kind of manage on the side. Okay, well, let's plug that in. And we don't necessarily say we have to manage that, but we should put it in the analysis so we have everything in one place. Once you've got everything in one place, kind of look at it, and the client might say, you know what, it might make sense to consolidate some of this, because now we can plan for it together instead of it being sort of piecemeal. And so that's been very valuable to us as well. And again, not that this is a land grab where we're trying to get every asset the client has, but where it makes sense to the client and to us, we can then manage the whole ball of wax. Now they've got it in the planning tool, and then when you meet, you can go back to that planning tool and say, okay, what's changed? If nothing's changed, great, we can look at the scenario. But I've got a client recently who came across an inheritance. And so all of a sudden you plug that in and that changes things dramatically. And so it changes for them what they might be thinking in terms of spending, in terms of legacy, in terms of current philanthropy, but it also changes for us because now their risk parameters are significantly different. So the client who's got $1 million, perhaps can't take some risk. The client who's got $10 million might say, well, I'm willing to be a little more aggressive on the equity side. On the other hand, somebody with the $10 million that they inherited might say, you know what, I just want to be really safe with this. Let's not take any risk. This is enough to last me the rest of my life. So those kinds of things happen. You plug it into the model, and it gives you a really good picture. I always tell people years ago, there was a rule of thumb that said in retirement, you can spend 4% of the principal per year, and you will enable yourself to keep that principal up, keep up with inflation, basically. So people would say that and they'd go, okay, that's great. They'd kind of walk away and they'd think, well, I don't know what that really means. If I spend 4%, I can do the math. When we do this modeling, we can say, okay, let's look at what you really spent. Let's forget about the 4% model. You kind of know what your bills are. You know how much you're giving to your kids. You know about this, you know about that. You plug actual numbers in, and now it becomes this really tactile, thing that they can touch, feel, and see what the impact is to the portfolio. So it's really, really helpful. And I think the clients really appreciate it as well. I can't tell you how many clients, when we started introducing this tool some years ago, said, this is terrific. This is really helpful.
So has it improved retention and helped consolidate external client assets?
I'm sorry, say again, Gary?
So has it improved retention?
Yeah, yeah, definitely. I think the thing that it does too then is the client, when there's a change in their situation, rather than them sort of thinking about it themselves or thinking, do I need to call somebody else, they think of calling you right away. Hey, we got that financial planning tool. Let's plug this in and see what it means. Clients literally come back to us and say, hey, I got something that has occurred. We need to put it into the planning tool and look at that. So I think it helps make assets stickier. But again, I think it's a benefit to the client. It's not just a benefit to us. I think the client starts to see that by plugging into this, they can do a better job of planning. And, in a lot of cases, it just helps them sleep better at night. They might have been comfortable before. Maybe we're not changing anything that we do, but now that they can see the numbers and it's more realistic, I think it helps them sleep better at night.
Do you ever let clients have a copy of this tool so they can play around with it themselves?
Yeah, we typically don't like hand it off to them and have them play with it. But what we will do, and I've got one client recently who ran through 5, 6, 7 scenarios, just came to us and said, what about these things? I'm concerned about this. And so we think that's a really valuable way to do it, is for them. It's a little, the tool isn't as intuitive to somebody who doesn't use it on an everyday basis. So for us to build the models and show it to them is a little more effective.
Tell me about Tower. What's the long-term plans? What are you looking for in the next 2, 3, 5 years? Where
Yeah,
you
so
going?
Yep. So we want to continue to grow the business. Our founders, for the most part, are out of the business, and so it's now the next generation, so to speak, is managing the business. We want to continue to grow the business. We want to continue to support our clients and continue to add to the services that we provide to them. And the way to grow the business these days, there's organic growth. So there's the onesie twosie, as I call it, where we'll find new clients based on. Still within our business, it's amazing after all these years. They say that over 65% of new business is going to come from existing client referrals. About another 25% is going to come from the centers of influence. And then the other 10% or so is going to come from just sort of organic growth that you can develop. So, given those parameters, we think we can grow the business through those channels. But we got to realize our clients are getting older. In an odd way, those clients are getting the 85-year-old client doesn't have a lot of people that they know that they can refer to. Some of their best friends are gone.
That starts in the 60s, doesn't it?
Yeah, exactly. So in a strange way, the older your clients get, and we love our older clients, but they don't become great referral sources. They just don't have people that they know who they can refer. The centers of influence, again, we can't really control that. I can't call that attorney every week and say, do you have anybody for me? So you can't control that. So that's business that kind of comes to you, and you hope that you get that and do your best to build those relationships. The other portion, the growth, the 10%, we're doing things like digital marketing. We've been doing it for years, where there's some sources out there that people who are surfing the web can find you and then find out about your services. That's an interesting way to grow the business, and I know these days with technology you've got to be there, but I feel like the market has just been overrun with these tools and with marketing, digital marketing to individual investors, that I think people are a bit tired of it and not responding the way they did years ago. So you've got to continue to find ways to grow the business organically like that. One of the best things you can do in our business is, as we talked before, is find other advisors who can join your business. So we've built up technology offerings, we've built up, like I say, the financial planning offerings, we've got great expertise in-house. We have found opportunities where there's an advisor out there who for some reason wants to leave their firm, or for some other reason they would like to go someplace else. And so firms like ours can bring those advisors in. If we have somebody who manages $100 million and they're looking to go someplace other than where they are, they come to us. Now we've grown our business by $100 million, and that's a significant growth. It's very hard to get through that onesie twosie. It's hard for me to get a bunch of $1 million clients through the organic growth. So that's one way you can grow, is by bringing on additional advisors. That was easier years ago than it is today, because you knew people in the marketplace, and you develop a relationship over time, and you think about, if you want to make a change, why don't you come over to us? Given all the private equity money that I talked about earlier, there are a lot of people banging on those guys' doors. And so that advisor who might be looking for a place to go has a lot of options, and he doesn't have to go seek them out necessarily, they're seeking him out. And so it becomes very competitive and in some cases fairly expensive to bring those advisors into your business. So that's one avenue, and we think that's a great way to do it. And again, we've done it in the past. We have advisors who've joined us from other places, brought their clients over. The clients are very happy with the services that we offer. That person has additional support over what they had before, so it's a win-win. The other thing you can do is you can merge with other firms. So I'm not talking about selling out and going away, but rather putting two firms together who have perhaps complementary offerings. That's something that you're seeing quite a bit these days. There's a lot to be said for scale in this business. As a $1.5 billion firm, it's funny, I'll go to conferences and I'll talk to other advisors and I'll talk to a guy who's got $350 million in his firm, and he'll say, wow, you guys, $1.5 billion, you guys are, big firm. And I'll talk to another guy who's got $4 billion, and I'll say to him, man, you guys are a big firm, and he says, oh, we're not that big. I got a buddy who's got $10 billion. Having scale, we all recognize, is a good thing. You can probably bring more to your clients with the more scale that you have. You can spend more on tools for the business when you have that scale. And so we're finding that there are opportunities to get together with other firms. Easier said than done. There are a lot of issues putting firms together. You've got governance issues, who's going to run it? You've got ownership issues, who's going to have the ownership? You've got growth issues, well, who's going to contribute to the growth? What if we merge with you and you go to sleep for the next 5 years and we do all the growth? What happens then? There's business models. Like I said, we do individual securities. If we merge with a firm that does nothing but alternatives, that might be additive, might not be. Maybe it's just two different philosophies of how to run money, and the two things don't go together. So you've got to find firms that are complementary, and I think mindset is important too. We really want to continue to grow the business. We're not looking to sell this. We're not looking to get out of the business. Everybody here still has a number of years that they want to continue to do this, and we really want to help our clients. We've got great clients. They're just good people. We enjoy working with them. Last thing I want to do is go sell the business tomorrow and somebody else takes over for that client. So when we talk about doing combinations, we would want to do something that was additive for us and that was good for the client. We always say any transaction we look at has to be good for three constituencies. It's got to be good for the clients, number one. It's got to be good for our employees, number two. And it's got to be good for our shareholders, which is most of us here in the firm. So that's how we look at it. And if number one doesn't work, if it's not good for the client, we're not doing it. If it's good for the client but not good for the employees, well, it probably doesn't make sense to do. So those are sort of the hurdles you have to get past. And believe me, everybody in the business is faced with this right now. There's a lot of things in motion, like I say, with the private equity money looking to buy firms, and then firms like ours trying to grow and figuring out if you can do combinations. So it's an exciting time, a lot of opportunity, but not as easy as just putting two firms together.
So what advice would you give to investors now, considering a more tailored approach to portfolio management?
Yeah, I think what we try to tell people is have some sense of what your risk tolerance is. And it's a term that people throw around. And I always say to people, risk tolerance is a funny thing. You can say you have a tolerance for risk, and then when the market takes a hit like it did last April, people are calling their advisor saying, should we be selling? Other people, when that event hits, they say they have a tolerance for risk. The event hits, they say, I'm okay. It's funny, I've got a client who is not a very sophisticated investor, but when the market takes a hit, she says, I'm not worried. I've seen this before. I'm 75 years old. I know the market has its hiccups. I know you guys got your hand on the wheel and you're paying attention. I'm not worried. So I think number one is know your risk tolerance. And again, that's a hard thing to know too if you have a couple. We'll meet with couples frequently, and one of them says, go growth. The other one says, I want safety. So you got to find that common, the medium between that. So number one, know your risk tolerance, and then make sure that your portfolio matches that risk tolerance. For years, people have talked about a 60-40 portfolio, 60% stocks, 40% bonds. That might not be right for everybody. We've got clients who have the ability to be more aggressive. They can be 80-20, and that's fine. And when there's a hiccup in the market, they understand that things come back. We've got other clients that might want to be 20-80, only 20% in stocks, and that can be for a variety of reasons. But we tell people all the time, stick to your asset allocation. If you do that, typically you'll be able to get through the hard times and you'll get growth during the good times, and it sets a reasonable expectation. These days everybody's aware of what the Dow is at. Everybody knows what the S&P is at, what the value is, how much the growth is. You can, have any number of sources in a given day that's talking about it. It's CNBC or even just the nightly news. They'll talk about the Dow and about the S&P. Sometimes clients want that return. They say, why am I not getting the returns the S&P gets? Well, 40% of your portfolio is in bonds. So you're not going to get S&P returns on that. Of the equity portion, let's take a look at that. Maybe you don't own all the things that are in the Magnificent Seven that drove all the growth in prior years. So, let's have reasonable expectations about what that growth is. And again, the financial planning tool helps to say, if I do X, whatever X is, just create your base case. What does this look like for the next 30 years with reasonable assumptions? Am I comfortable with that? If you are, then stick to that asset allocation, pay attention to what you're doing, but don't try to veer off of it too much. I just don't like it when people see an opportunity to put money into something that's hot. We've seen that a million times. I've got clients who put money into private businesses. It's a guy that I know has this business. I talked to a guy recently, he had something that a guy was going to give him a 20% guaranteed return. And I just said, I don't believe it. I said, I'm not calling you stupid. I'm just saying there's no such thing as a guaranteed 20% return in some private investment. And he said, well, why? I know a guy that did it. He gets these checks every quarter. I said, I don't believe the 20. I don't believe the 20% return. Why is he coming to you, asking you to invest? If I were him, I'd make one phone call to a big pension fund, and I'd guarantee him 20% returns, and I'd get a couple $1 billion from him. It just doesn't exist. So, the old adage of if it looks too good to be true, it probably is. So just be careful with the things you invest in. And if you are using an advisor, find somebody that you trust and, take their advice and be smart about what you do.
Thanks, Nick. I think that was a really, really good podcast. It's been a pleasure talking to you. How can listeners learn more about Tower Bridge Advisors? How can they connect with you?
Sure. We're on the web, www.towerbridgeadvisors.com, advisors at ORS, and we'd be happy to talk at any time. And if somebody wants to, if you go to our website, you can sign up for our market commentary, which we do one day a week. And like I said, that's sort of a 50,000-foot view of what's going on in the markets. It's not a stock picking letter, but rather it's sort of big picture. It'll talk obviously about, like right now, about tariffs, about what's going on in Congress, what the impact is of AI on the markets, that sort of thing. And so by reading that, you can get a sense for who we are and how we manage money. And if you're interested in more, let me know. You can find my number on the website as well.
Fantastic, Nick. Thanks everybody for listening in, and we'll be back in the next few days with another episode. Nick, I'll talk to you in a second. Thank you everybody once again for listening to this podcast. Thank you.
Thanks, Gary.